recording, I'm once again going to say nothing in this meeting is intended to be individualized investing advice. So again, that's never been a problem, but I think that is probably all we need to get started. So I know Laurie's going to share her screen, show you what she's been preparing, and we will launch into it.
Okay, can you see my slideshow?
Yes.
Okay. Can you see my son over my shoulder?
Yes. Hey, Sam.
Yes. Hi. He's apparently getting investing advice too, which actually is good because a lot of what I learned from my dad, and he was the one that would say, "Well, you just need to do this and do this," and most of the time I didn't know what he was talking about.
I can help you. I can help you.
Yeah, he would help me figure it out. So, so these are just my ideas, and like I said before, somebody else might suggest something else.
I'm gonna go call the doctor.
So, I'm going to start with why do you want to invest? And when I say invest, that usually means saving money in the marketplace.
Yep.
It doesn't usually mean putting money in savings, even though that's part of investing. But lots of times when people say, how do you invest, or are you in the market, it usually means that you are doing something with stocks or bonds or real estate or something like that. And the reason you would want to do that is for your emergency fund, which has been really important recently because a lot of people have lost their jobs. And so that sort of is like something that we know we need to focus on. Big ticket items like cars and houses, and of course the long-term retirement. Women live longer than men, but they're usually paid less than men, and often have the advantage of leaving the workforce and then returning. And it can be hard to get back into that same position that you were in when you left. So that's why it's important to think about more than just saving things in a savings account, but doing something extra with it. So, like I said, when you invest in the market, that's usually the stock market. And here's this nifty chart that shows how the market has gone in general from 1896 to 2016. And this is the link that somebody sent us and Sarah posted on our Facebook group. So as you can see, I don't know, do you guys see my cursor if I move it?
Yes.
Okay, so see, there's a general trend upward. Oh, sorry, my cursor can do other things too. A general trend upward, even though there's downturns. Like here's the Great Depression, here is the 2008 housing crisis, and sometime soon there'll be a little dip up here for whatever they're going to call this. But in general, the market comes back up and goes up. So that's why it's in general a good idea to invest in the market. And you can do it without having a lot of knowledge of stocks or how to choose stocks or how to get in and out of the market at the right time. And we're going to talk about some strategies for doing that. So these are the types of things you can invest in. And I kind of did it ordered by what you might know or what might be most important for you to know, to something that maybe you can get away without knowing too much about. So obviously there's a checking and savings. There's a money market, which some people might have heard of and some people might not have. It's basically like a different type of savings account that your bank would offer. There's mutual funds, which are stocks and bonds that you don't actually buy directly. You buy it from a company that has done the effort of figuring out what stocks and bonds to buy, and they do all the work underneath the covers of buying and selling the different stocks and bonds. So that's what we're going to talk the most about. There's ETFs, which are exchange traded funds, and that also has stocks and bonds, and they're a lot like mutual funds. Sometimes they'll have lower minimums, and sometimes they'll have lower fees, but you can essentially think of them as the same as a mutual fund. Stocks, if you own stocks, that's when you're choosing an actual company and you're saying, I think this company is going to be great, and I'm going to own a share of this company, which basically means you're loaning them money to do their work, and they are going to either give me dividends, which means when they do well, they'll give you money back, or you hold on to that share and wait for it to go up and increase in value. And the reason it would increase in value is not just because the market goes up in general, but because you did the work to choose a company that is making progress and it's going up and not going down. So when we say the stock market in general is going up, that's because it's looking across several different companies. So for example, these days you might look at, say, McDonald's, Coke, IBM, and Apple, and they might go up and down differently, but if you average them out, they probably would go up. Most likely because Apple is doing so well, and so they kind of pull the average up. So that's why if you buy an individual stock, you kind of have to know what you're doing, because you can't just randomly pick one. You have to be a little bit more careful. Bonds, you'll hear people say, are you in the bond market? And that essentially means you're either using municipal bonds, which are like a loan to a city, or treasury bonds. And bonds in general are more stable. You're less likely to lose money on them, but you won't make as much money. So for example, you could buy a bond for say $1,000, and it will have a period of time, say 2 years. And your agreement is that I will loan you $2,000, which is buying the bond, and at the end of my term, you will give me $500. So no matter what, you're getting that $500 at the end of the term. And those are usually very safe, because not very many cities and the US government, they're not likely to go bankrupt. But as we found out in the last crisis, that can happen. So you can lose money on bonds, but in general, they're very stable. But you don't make as much money because there's less risk involved in general. So here's some, like I said before, we're going to talk mainly about mutual funds. So I'm just putting some terms that people kind of throw out a lot, that if you haven't heard before, you would not know what they're talking about. So they talk about small cap, mid cap, large cap funds, and that's basically saying the size of the company. So small cap funds are usually the technology funds, the startups, the ones that are up and coming, but that might fail. So those are a little riskier. Mid cap, middle. And large cap are the larger companies, like the big ones like GE and IBM. When people talk about the S&P 500, they're basically talking about a selection of stocks that were selected to be a good sampling. And an easy way for people to tell in general, is the stock market going up or is it going down? And that's where the 500 comes from, is just a set of 500 stocks. So there are mutual funds that are called index funds, and those are the funds that follow that index. So if you wanted to follow the S&P 500, you need an S&P 500 index fund. And that would allow you to kind of go up and down with the market because somebody else is managing what those 500 stocks are. You don't really have to do anything. The company doesn't really have to do anything because they are just buying and selling those stocks as they go up and down in the market. And so that usually means they're a lower fee. There's something else that you're going to hear, which is a load. And it's a fee that you usually see when things are purchased or sold with the fund. And you'll hear no load fund. Is that a no load fund? And those are usually the ones you want. No load funds are the ones where the broker selling it to you or the company doesn't take a fee at the beginning, which is essentially a fee for you to buy it. Some of them will have end load funds, and that's a fee you pay when you get out of the fund. So the loads are a little bit different from the fees. The fees are something that's an ongoing charge that is basically you paying for the company to manage that fund. But you also have to be aware of loads because sometimes you'll see a mutual fund that has a very low fee and you think this is great. But when you look at the load, it's got a high load. And high load would be like 5% and up. A low fee would be like some of the fees would be as low as 0.15 or 0.25. So the fees in general would be less than 1%. And these can matter when you're doing this.
Hey, Laurie. I'm sorry, Laurie, sorry to interrupt. We have just 2 clarifying questions and comments on the last 2 slides. I thought maybe we could jump in before you moved on.
Great.
The first, there was a question on treasury bonds from your bond slide.
Yes.
And so the question was, are treasury bonds state, federal, government, or both? And so I'm happy to clarify, or if you wanted to clarify what the term treasury means, that was the first question that we had.
So my understanding of it is that it's the national government. Is that
Right.
true? Or would you call it a state bond? Would you consider that a treasury bond?
Yeah, I mean, treasuries are a specific type of bond. So the way you have it listed here, you have a treasury is a specific bond from the U.S. government, or that's issued by the U.S. government. So treasury with a capital T specifically means that it's issued by the federal U.S. government. So yes, that's what I just wanted to clarify that for the person who had a bond question.
And so those are usually very secure.
Right.
And they're probably issuing treasury bonds right now because they're basically opening up the purse. The government's opening up the purse and loaning money out to people. But as a result, they're basically going to need more money. So they are asking people to buy treasury bonds. And when you buy one, like I said, it'll have a time period and you'll get a certain amount of money back. So so you might remember, like during World War II, you might see posters that said, you know, buy bonds, and it was to support the government. And what's happening now could potentially be other countries buying our bonds. And that's where some of the interaction with China and other countries like that comes in because they're buying our bonds.
Right.
Me personally, I have not interacted with bonds until I inherited stuff from my dad, and he had a whole bunch of treasury bonds, which were just kind of like tucked away in his safety deposit box. So they're not usually something I look into developing with.
Yeah.
I don't know about you, Sarah, if you dip into those.
I mean, the gist of the story with treasury bonds are that, like you mentioned before, the most important thing to know about treasury bonds are that the issuer, the US government, has never defaulted on a bond. That means they've always paid back the interest and the principal on all money they've ever borrowed since the beginning of our country. And so for that reason and for that track record, they're known to be very, very safe investments. Now, in exchange for that safety, you get a relatively low rate of return. So you can lend money to the US government for 2%. Maybe you get 2% on your money. Maybe it's 1.5, maybe it's 2.5. They publish those rates all the time. But that's what's special about the Treasury market, is that the US government has never defaulted on a loan or on a bond, so it makes them very safe. And then if we want to move on from that, if you have any other questions, oh, hold on. Now there are more Treasury bond questions. Sorry, y'all. Let me see here. Can you buy Treasury bonds through a bank or credit union? Where do you buy them? You can actually buy Treasury bonds directly from the US government through the Treasury Department if you want to. I will say that most people, like Laurie mentioned, mutual funds, most people buy Treasury bonds nowadays through a mutual fund that invests in Treasury bonds, but you can buy Treasury bonds directly from the US government. I think you just go to treasury.gov. Sorry, Laurie, one more. There's one more about what time frame is typical for a Treasury bond to mature.
I think I've seen different numbers: 2 years, 3 years, 5 years, 10 years.
Yeah.
20 years. There's different amounts.
Right. Like in the Treasury bond market, they issue something, very short-term bonds that they call Treasury notes that maybe mature in the next month or couple of months. Then they issue Treasury bills, Treasury notes, and Treasury bonds. Don't get too hung up in that. The gist of the story is that the US government can issue bonds that mature in the next 1 or 2 or 3 months along that time frame, all the way out to 20-year bonds and maybe 30-year bonds. And then they've even talked about issuing 50-year bonds. And most of the bonds are issued at 1 year, 5 year, 7 year, 10 year, but they can extend all along the maturity curve. So when you're buying a bond, you will find out. I mean, part of knowing what kind of bond you're buying is knowing when it will mature, but you have the choice. Do I want a very short-term bond that matures really soon, or do I want a long-term bond that matures far into the future?
Yes, and I would say in general, bonds are much more stable, but if you have investment goals where you're trying to follow that stock market trend up, you're not going to get there with bonds because the interest rates are very low. And yeah, I would bet that you could probably even find like a money market or a CD or something that would approach those same rates. So it's good to know about them, but I don't know a lot of people that run out there and buy a bunch of bonds. And like Sarah said, and we're going to talk about it in the future in this presentation, some mutual funds will give you a nice mix of things that would include bonds. Oh, I'm going backwards. Okay, so when do you start? Well, the short answer is you start now. You don't really wait for the market to come back up. You don't wait for it to come down because no one ever knows when that's going to be. Of course, if the market's down, like it was recently, that's the perfect time to scoop up some bargains. But you can't just wait for that to happen because no one knows when that's going to happen. And you never know. So you can use this term dollar cost averaging, and you guys can look that up if you want to see more examples of it. But it basically breaks down to knowing that you're going to get in the market and you're going to start by buying a fund or some stock, and you're just going to keep buying it periodically over time. So you could say, okay, I'm going to start with $500 of this particular mutual fund, and I'm going to, every month, I'm going to buy $50 more of it. And you just keep doing that through the ups and downs of the market. And if you're satisfied with the fund, you will be following the upward trend of the market. So it might go down, it might go up, but the upward trend should still hold true because it's held true for so long with the market. How do you know if you're in a good fund? You could say, I'm going to do this and I'm only going to check once a year and see where I'm going. Over the past year, what was my rate of return? Do I need to find another fund? Am I making as much money as I hoped, or am I losing money? And then you could decide consciously, okay, I'm going to make another move. So that way you don't have to watch it all the time, but you could set yourself a goal of when to look at it. And this is kind of similar to what I heard from, I like Gretchen Rubin, as you guys might have known, and from her podcast, she had a guest who said one thing she is doing to just avoid being crazy in this time and to know, is she doing the right thing? She said, I am only going to make a decision every 2 weeks. And this is very much an aside, but I thought it was really useful, and it kind of applies to this too. She's an at-risk person, so she doesn't know, what should I do? Should I not be going out at all? Can I go out a little bit? Do I have to worry about doing takeout? And she said, that's too much to worry about all the time. She said, I'm going to make my decision every 2 weeks. So after 2 weeks, she talks to some of her friends, she does some more research, and she says, okay, now based on this new knowledge I have, what do I want to do? Do I want to change what I'm doing or just continue on? And she said that was a really good technique to not regret her past decisions and not worry about it all the time, but also set a checkpoint of when she wanted to spend some time thinking about it. And that really applies for investing too, because lots of times people get stuck on, it's like, oh, only I had bought that stock when it was low. Now look at it. I can't afford it. And then you just kind of beat yourself up about it. It's like, well, you know, the 2 weeks ago, there was a lot of stuff you didn't know. Now you have new knowledge and you can make your new decision. You can decide, you can look at that stock again and say, or a fund, doesn't have to be a stock, and say, I like where this is going. I bet it's going to keep going up. I'm going to purchase some and not think about it until my next checkpoint time, which she, for the COVID-19 stuff, she was using every 2 weeks. But for you as an investor, you could pick every year or every month, every 3 months, whatever you feel comfortable doing. And this could be just your checkpoint time. It doesn't have to be the interval that you decide to invest. You could say, every month I'm going to put $50 somewhere, and you just do that no matter what. But you still have your checkpoint time, say every 3 months, and that might move where you put your money, or you might say, this is going great and I got a bonus, so I'm going to move this money over here, or I really like seeing the numbers go up when I get those statements. I'm going to put more money in. So that could be one thing that you think about at your checkpoint time. So I don't want to belabor this point, but it kind of is true. It's something else they say a lot about buying real estate. When's a good time to buy a house that I want to use as an investment property? They always say, now's a good time. And I went to another meetup, not the one that you guys went to, Sarah, and they said, you know, is this a good time for me to buy in this market? You know, the numbers don't really make sense. And the presenter basically said, yeah, the Austin numbers never really do make sense. But yeah, it's a good time to buy. There's still stuff out there. You have to look harder, but there's still stuff out there. You can still make money. It might be a smaller amount of money, and it might take you longer to recoup your expenses, but there's still stuff out there. Okay, so I'll go on from this point. I guess I kind of belabored it, but is something I have to keep reminding myself. So that's why I kind of went over it a lot.
I think that's a really good point to belabor, though, Laurie, because I think you're right that that's exactly where beginners get hung up. Is, you know, one of the ways is now the right time, or is some other time going to be the right time? And you know, you hit the nail on the head. You are never going to know what the right time is. So
yeah, even
why is it now the right time, right?
Yeah, even the dudes, you know, in the $1 million suits, you know, up in the big towers in New York, they don't know. They are just guessing as well.
Mm-hmm.
I mean, they might be guessing with more experience and more knowledge, but they're still guessing too, because nobody knows, because there's that emotional component of the stock market that they still don't have a really good way to take that into consideration. Let's see. Okay, I already talked about this. Is it okay to go on from this one?
Yes. Yeah.
Okay. I think I'm going backwards. Yes. Oh, okay. So if you're going to start, what should you do? Well, the first thing you want to do is put money aside so you have your emergency fund. And so that means stashing whatever you have that you don't need in a savings account, in a checking account. Lots of people like to do savings accounts because then if it's not in their checking account, they know they can't touch it. It's not easily reachable. And so you want to put at least 6 to 9 months of savings. And in this current environment, I would almost even say a year, but most people recommend 6 to 9 months. And then if you have debt, you do still want to keep paying off that debt. Some of the recommendations that I've read about recently say if you're having trouble with your debt, talk to the lender and see if you can make an arrangement with them to lower how much you pay now or to spread it out. What you want to do is try and get it to a lower amount so it's still affordable. But even if we weren't in this environment, you would still want to be putting some towards your debt, but also putting some money aside to invest. Because remember, you want to periodically put money into the market to set it aside. Not only will it then go up with the stock market, but once you set it aside, you kind of forget about it a little bit and it will just grow for you. And you'll be glad later when it's there. If your company has a 401k, you want to invest in your 401k, and many companies match it. So, like say my company, you could put up to 6% into the 401k, and they would match up to 3%. So I would invest at a minimum the 3%, so you could get that free money that's matching from your company. And I actually usually max out my 401k because once again, it's that money that gets set aside. It comes out of your paycheck. You don't see it, and it just grows on its own. And usually they give you funds that you can put your money in that are pretty good. They might not be the best things in the world, but they're pretty good. And so that money is growing for you without a lot of effort on your part. And it's pre-tax dollars, which is another benefit. Start a Roth IRA. So IRAs are individual retirement accounts. These are accounts where you put money and you're not expected to take it out until 59 and a half, I think. And there's a particular one called a Roth IRA, which means that when you take out that money, you don't pay any taxes on it when you take it out. So if you started it low and it just kept growing and growing, even if you couldn't put more money in it, it's probably going to grow. When you take out that money, all this extra that it grew, you don't have to pay any taxes on it. Another bonus is that whoever inherits it from you, they don't pay any taxes on it either. They just inherit it straight out of the Roth IRA, which was another super cool thing. And I think, Sarah, are these pre-tax dollars with the IRA, or
in the
post-tax?
Yeah, just really, really quickly, any account, any retirement account that has the word Roth in front of it, the idea is that you do pay taxes on your earnings today, but when you take the money out in retirement, you don't pay taxes. Any account that does not have the word Roth in front of it, whether it's a 401k or an IRA or whatever kind of retirement account it is, a traditional 401k or IRA, you don't pay taxes on your earnings today. You put all of that money into the retirement account, you invest it, it grows. And then when the money comes out, that is when you pay taxes. So the term that we use is tax deferred. You are deferring your taxes into the future. Unless it's a Roth account, then it's tax-free when it comes out.
Which is really cool.
It's really cool.
It's like a total bonus.
Yeah.
So it's really worth it to put money in a Roth IRA, whatever you can. There's different limits depending on your age and how much money you make every year about how much you can put in there. But when you're like starting out, it's really hard to think that far in the future and you think, well, no, I have other uses for the money. But when you get to be older, you'll be so relieved that you did it and put whatever you could away in it.
Hey, I'm sorry, Laurie, can you go back? There's a question about that last slide that maybe we can you can expand on right now. The question from Shannon is, first, she loves the current slide. And her question is, how much investing should one be doing? For instance, do you max out the contribution in your 401k, max out the Roth IRA, or max out the traditional? And then what do you do with the money that's left over? Do you have, I think that question is kind of getting to one that's pretty common, which is like, what order should we be doing those in? Do I have that right, Shannon?
I think that's an excellent question. So I would max out the 401k at your company if it's offered, because previously companies just offer pensions, and they don't anymore. Some of them are more generous about their matching with the 401k, and so they kind of are thinking, well, that's your vehicle now. That's how you're supposed to save for your pension. So max that one out. I would max out the Roth IRA. Is however much money you have to put in it, I would put as much as possible in it. And if you're older, there's like actually a little catch-up clause where if you're older, you actually get to put a little bit extra in it to help you catch up. And then I would do a traditional IRA, which also has limits. And the rest of it, you basically just have it in your, it becomes sort of like your normal savings. You're going to put it like in a mutual fund or some other investment, and we're going to talk about that later, because a Roth IRA, it's not like you pick a Roth IRA and that's all it has in it. You pick funds and say, this is my Roth IRA fund. Same with the traditional IRA, and usually the same with the 401k. So regardless, you're going through the work of picking funds, bonds, things like that, and then they become identified as a certain type of thing, a 401k, a Roth IRA, or a traditional IRA. Would you have any other advice or suggestions?
Yeah, I mean, there's a couple other questions that have popped up around the same topic. And the general question, and we can get to specifics in a little bit, the general question is along these lines of, where's the best place for me? What's the best account for me to invest my money in right now, right? And so I'm going to punch on this a little bit because it's an investing for beginners type of slide deck. So what I'm going to say and just offer to the group is, if you are truly a beginner, the path of least resistance is to put as much money as you can into your employer-sponsored account, meaning your 401k. That whatever money that you can save without worrying about percentages, the most amount of money you can save, the easiest way to do it is just put it in a 401k or whatever plan is sponsored by your employer. That's the easiest place to start. Don't worry about the Roth. Don't worry about the traditional. Step one, save the money as much as you can. Step two, put it into an account somewhere. And I would say if you are truly beginning, skip over the Roth versus traditional part. Just pick something or pick both and just put the money in there and then invest it and start getting the habits growing. So I'm saying that as I'm offering that to people who are truly beginners that don't make too many decisions a big deal, if that makes sense. So, and there's a lot of nuance around that, but that the optimization part of Roth versus traditional, there's some conversion questions. There's like, do I take the match at my 401k and then max out my Roth and then come back to my 401k? There's a way to optimize this, but that's a question, that's something that you do down the road as you continue along this investing path. I think that for like a true beginner, save the money, put it into whatever retirement account you have access to and invest it. And don't get too caught up kind of in some of the this or that aspects of of the questions, whether it's Roth or traditional.
Yeah, and yes, I would actually say go for the Roth IRA.
Yeah.
And I should have said at the beginning, we're actually going to go through some companies that have funds that I like, and because when you start off, you go visit those company websites and they're totally confusing and you have no idea what you're supposed to do or which to choose from. Some of them have like thousands of things to choose from. So we're going to step through some just to give you an idea of what's available and what you might want to go look at. And so some of those questions about what do I do, maybe those will be answered when we get to that.
And there are also some really great discussions going on in the chat box too, right? For other people who are in the group who, you know, if you ask a question, someone else in the group might be able to, you know, offer more nuanced responses that are applicable just to the specific questions while Laurie's going through the more general slides that she has prepared for the group. So again, this is what the Austin Women's Investing Group is the sharing of all of this information. So keep.
Yeah, that's great.
Yeah.
Okay. Okay. So, like I said, I'm pretending that you all are my friends, and you are. And they're speaking. And so I would say, look, don't even worry about the stock market. Just find some mutual funds. And some of my favorite ones are Vanguard, Fidelity, Ellevest, and Asset Builder. And so we're going to go over those, and I'm going to talk just a little bit about them. And I know there's things that I've left off. And so if you guys look at the slide and you're like, but you could go ahead and add it to the comments, add it to the chat. But I didn't deliberately leave something out. There's just like so much to say about all this. I'm trying to make it more straightforward, you know, so you don't get as overwhelmed. So if you ask somebody what's a good mutual fund company, almost everybody will say Vanguard. And that's because they have low fees. So you don't have to pay very much to own one of their funds. They also don't have any loads. But I was digging around on their website, and some funds said they did have some purchase and redemption fees. The lowest minimum that I could find was $1,000, and then they had another set of funds where $3,000 was the lowest one. And they go up from there. The types of funds they have that I wanted to talk to you guys about are target retirement funds, which are funds that you invest in and you say, I'm going to retire in 30 years and I'm just going to buy a chunk of this fund and I'm going to keep putting money in it as time goes by. So what the people managing the fund will be doing for you is, if you're young and 30 years from retirement means you have a while, they'll put you in the market a lot. So you'll get a lot of the riskier but higher return funds, so you can earn more, and they'll automatically shift you towards the more stable funds that will have bonds and things like that in it. so that as it gets closer to your retirement target time, the fund is shifting with you. And so that's basically if you went to an investment advisor and you had somebody who was managing your money for you, they would basically be doing that same thing. So it's kind of a little, it's totally easy way to get a balanced portfolio that won't leave you out there, so that if the market totally crashes, you lose all your money. They have some life strategy funds, which we'll look at in a minute on their website. They have index funds. Those are the ones that will follow common indexes like the S&P 500. And like I said, they have a ton of other funds that might target different industries, like the medical industry or tech industry or oil. It's like, it's almost anything you can think about. So like I said, I'm going to go over these companies and then we're going to go visit their website and just browse around for a little bit and talk about what they have available to make sure that people are comfortable just looking at it and making decisions. Fidelity, Fidelity, that one's a huge company. If you don't hear Vanguard, you probably hear Fidelity. Vanguard's known for its low cost fees, but Fidelity is apparently trying to compete with them because they said that their index funds have zero minimum and they don't have a load, and the fees were very low as well. So they would definitely be a good place to start. They also had something called thematic funds, which we'll visit that page, but like if you wanted funds that are socially responsible and you had no idea how to find them, they had a list of funds for that. And they had a big variety of funds along those lines. And like I said, they will have thousands of other funds for anything you would want. Ellevest is a fairly new company, and it's started by a woman. It focuses on women who invest. It has a zero minimum and a very low fee. Depending on how much personal interaction, you'll have higher investment rates. And the same is probably true of Vanguard and Fidelity. But what they do that's different is they have computer algorithms that will figure out for your investment goals what you should be investing in. And you can invest for a variety of targets, like my retirement target, or I want to buy a house and I just want a savings account for a house, or I just want to start saving money and accruing wealth. So they have a slightly different tact than some of the other companies, which I find really interesting. And I really like the fact that they're focused on women. Lots of, like, they have a great newsletter that you guys could sign up for free. And a lot of the things in the newsletter really resonate with me. And a lot of them are things that we talk about in our news group. So that is really cool. Oh, Asset Builder. Asset Builder is started by, I've forgotten his name, somebody in Dallas who used to have a radio program, and he would advise.
Scott Burns.
Scott Burns, yeah, Scott Burns. Yeah, and he would always advise people on low fee funds, low cost funds, and building a portfolio of low cost funds. So that's his general philosophy. He's not with the company anymore, but they still follow that philosophy. And the way that they will help you set up your savings is you pick how comfortable you are with risk. And they have like 8 or maybe 11 different risk profiles. And what you're in, what they put you in will change. So for this company, they have a set of portfolios, just 11, that everybody will use. you personally pick which one seems to fit your current place in life, your ideas, how much risk you can take, while still having low fees and no loads. And they use something like a fund that normally you only get from a broker that does have a load, but they have an agreement with this company to not have loads, and it's dimensional funds. It's the name of the fund if you go and look for it. They have a higher minimum though. So this would only be something that you want to look at if you have some money stashed away. For example, if you have money in your savings account and it's just kind of sitting there earning 1% or less, this would be a perfect candidate for that money stashed away in your savings account. And I have used this one. I've used Fidelity, I've used Vanguard. I like both of those. Elvest, I haven't actually used, but really love their platform and their newsletters and everything. But I have used this one, and I have a brag on Sarah that my fund, my portfolio with Asset Builder almost met the same performance as Sarah. And I don't know if I even told you I was doing that, Sarah.
Dang, Laurie. I didn't know I need to know I'm competing with someone. That's what I always assume I'm competing with someone.
So you won out, Sarah. Yay, Sarah. You guys, Sarah's the best. But that just goes to show you this is a pretty nice fund. They were doing fairly well compared to a human managing my personal portfolio. So that's kudos to both the fund and Sarah. So that's the end of my presentation, and then I was going to visit the websites, these websites, and look at different things that I found interesting on the websites, and basically give you ideas about what you might want to do if you were going to pick something to start with. So I thought we'd take a break now and see if there's any questions before I do that. I'm sure once we go to the websites, you guys will have lots of questions, some of which we might be able to get to and some of which we might not, because I find that once you look at a website, you automatically have tons of questions about things, and we'll just see what we can get through.
Yeah. Okay. Thank you so much, Laurie. This is really, really helpful.
I hope so. I hope it was helpful to you guys, and like not too boring. I was worried that people might find it boring, but sometimes it's good to hear something again. It kind of like reminds you. It's like, oh yeah, I really should be investing every month. Or I forgot the stock market always comes back. Don't worry.
Yeah.
So yeah.
So I'm going to stick with, I'm going to do a couple questions now and then save a few for further down because they may end up getting answered.
That sounds great.
There's a few that are really like a little bit more advanced. So if you asked a question, we're going to save the chat. There are a couple questions that y'all asked that I might put a pin in and maybe reach out to you individually because there's a few questions I think are really applicable to the individual who asked them, but might not be applicable to the rest of the group. So we're going to save the chat and you might hear from me later on some of those questions. But here's one that comes up really often, Laurie, that I'd love to hear your input on. One of the questions is, when you're choosing a firm that you're working with, so I call it the custodian. So for example, you're choosing Fidelity or Vanguard. Is there a benefit to having more than one company that you're working with, or should you just choose one? Kind of what are your thoughts on that?
Okay, yeah, I do have some thoughts on that. When I started out, I chose different ones because I wanted to spread my risk out. Even if sometimes I would pick a fund that like Vanguard had just because it got really good ratings and it was a nice fund and it had really good returns. But I might find one at Fidelity that I liked. And sometimes I deliberately did that where all my money wasn't at the same place. I am finding recently that it's easier to manage if everything is in the same place. And not finding right now I'm not seeing a lot of differences between them, and I'm sure there are, but right now Fidelity is the one that I'm dealing with the most, and I'm also finding that customer service is starting to be a big bugaboo for me. Fidelity has excellent customer service, and I think Vanguard does too. And their websites are really great to help you figure out what you're doing, get education, point you in the right direction. Ally Bank is supposed to have some of the best rates, but recently we were working with them, and they're an online bank. You can't go to any of their offices, and we were not happy at all working with them. And so they kind of got crossed off my list, even though they have good rates. So I guess my short answer is, one, just pick one and start with it. Two, don't get stuck at a company. Go ahead and look at different ones. And then just whichever one you feel comfortable with. A lot of them, if you want extra help managing your portfolio, they have people that will do that, and it will increase the fee a little bit. So yeah, I guess that would be my answer.
Great, thank you. Changing a question on a related topic that you spoke about before, there was a question on what are your thoughts as to the percentage of income that people should be trying to save and invest? Have you come across any, people often ask me about rules of thumb or like a goal, a target percentage to get to. Have you ever looked into that or thought about that?
I never actually followed that as well as I should. And I got by because I tend to be a saver because my dad was a saver. I think I can put something out on the web because I think the lady who came and talked, Sarah, who does that, she does a lot of the talk on budgets and stuff like that. I think she had.
Oh, Sandy. Yeah, Sandy did.
Yeah, Sandy had some good numbers that I saw recently when I was going through my notes. I think it is really personal, though. I hesitate to throw out numbers because I really do think it's personal, but 10%, 20%, sometimes it might matter what goal you're going towards. You might want to throw more money at it. So I don't know. Other people might have other suggestions on that. And I'll look and see what Sandy said about it too, and post it on our. I'll post it on our Facebook group.
Perfect. We have a couple folks who would definitely like to see the Asset Builder site and some of the sites you're going to take us to. So maybe we can go to that for the next few minutes and then back to more questions.
Okay. Let me take a note about checking out Sandy's stuff. Okay, so you guys see this webpage?
Yep, yes, the Vanguard website.
Okay. Yeah, so we're gonna start with Vanguard. Like I said, they have a very nice website, advice, news, costs. We're starting here with Vanguard mutual funds and how to choose a fund. Since I'm suggesting things to my newbie friends, I would say, okay, go to Vanguard, pick one of their general funds. So we're going to look at the Target Retirement Fund and the Life Strategy Fund. So for the Target Retirement Fund, low cost, that's one of the things they're known for. And you look here and you say, how many years to retirement, or which was your birth year? You pick one of these, and then it's going to show you, I think I picked up 50. I picked this fund. It's going to show you what that fund would look like. If you want to look up that fund somewhere, like on Yahoo Finance, this is the fund ID, and this tells you in general what it is. But this is a fund where you're planning on retiring. They actually say between 2048 and 2052. Here is the risk potential. Since that's in the future, it leans towards the riskier fund at this point. Mutual funds have prices. They have prices that are defined every day, just like stocks. Stocks have prices that go up and down. I think mutual funds have just one price from the close at the end of the day. And then, so this one went down. But if we look at, so this is an index fund. It's basically following this index, which is Target Retirement 2050 Composite LX. I don't even know what that index is, but it's following the index very carefully. This is this fund, and here's the index. So after a year, this fund's not doing very well. And it's like, well, that kind of makes sense. This is riskier, and it'll be in the market a lot. And the market, you know, has been really weird lately. So lots of times I'll look at what it did in the last year if I'm evaluating a fund, and I think, does that match what my general feeling is for what's been happening in the past year? And it's like, well, yeah, the market has been weird. 3 years, it, you know, did okay. The benchmark actually did a little bit better on this one. Oops, sorry. And 5 years, it did better. 10 years, it did pretty well. And this fund has been here since 2006. And it's pretty close to the benchmark, slightly off. But if I was evaluating this fund, I would say, yeah, this is pretty close to the benchmark. In general, I would expect the performance of the funds to kind of even out over time. Sometimes it's what they do for the 10-year benchmark that's more important than the 1-year benchmark or their since inception benchmark. I also really like to see how long a fund has been around, because that tells me how stable it is and if you're likely to see the same performance, or if it's a fairly new fund and maybe they're kind of working on trying to see how to manage the fund. I noticed they have this is a little unusual to see, but rather than giving you a nice graph of what they did in the past, they are going to show you, oh no, this is from the past. So here's from 2010 to 2020. And here's the dip. This is, you know, the current dip in the current market. It's starting to go back up. But in general, that's a pretty nice curve going up. It looks a lot like the stock market curve that we saw before. So this wouldn't be a bad fund. And here, this is another thing to check. What are they in? Well, so you could go out and get these same percentages of all of these funds individually and do it yourself. But this combo fund, that's balanced fund, is they basically will do this for you. And like I said, since it's a retirement fund, as it gets closer to retirement, the numbers will change. This index fund, which is going to be the stock market index, will go down, and this bond fund will start to go up. So it'll kind of flip as it gets closer to 2050, because that's its goal. I also want to go and look at the other one, which was Life Strategy Fund. And this one is where you can look basically what you want and what your risk level is. So, so the risk level for this one is pretty low. And if you see, not very many stocks, but a lot of bonds. And as you guys were questioning us about before, it's like those are very stable. So this one is more likely to maintain the value in the fund. But you know, the flip side is not going to make as much money. And as you get over to the more aggressive one, this one's it's not even a 5, it's moderately aggressive. It's got a lot of stocks and just a few bonds. So this one will dip more up and down with the market, but it still has some bonds in there to kind of stabilize it a little bit. One thing that's kind of confusing for newbies is like, what does this mean? Am I interested in income, growth? I have no idea. Just basically think about it as how much it's involved with your risk, how much you want to preserve your money. If you're mainly interested in income, which usually would mean you're about to use the money in that fund as your income, then that's why you would be interested in this one, a lower risk fund. If you're interested in growing the money, you want a growth fund. And so growing the money carries more risk with it because you're growing with the stock market. So you get the growth, but you also get the risk. Here's the expense ratio, 0.13, which is very good. And I don't remember what the minimums are for these. Maybe 1,000 is my guess. So these are the Vanguard funds. If I was starting out, I would choose one of these. If you want to dabble more, they had a little tool so you could get advice to figure out where, or they would bring up a short list of select funds. I'll look at this too, because if you first see a screen like this, it is very confusing. Where you basically have a bunch of funds dumped in front of you and you have no idea which one you're interested in. So once again, you look and see the change. This is going to be the daily change. And here's year to date. 1 year, 5 year, 10 year, and since inception. So if we're just looking at these market funds, you will see that this one's doing pretty good. It's index Admiral shares. This one, last year, it did really well. Well, that makes sense. The market was doing pretty well last year. For 10 years, it makes about 3.9. So if you got in this fund, you could expect around that much. This one can't tell you what it would do in 10 years. It hasn't been around that long, but you can kind of guess. It didn't do as good during a good year, and it's pretty close to the 5 years. So, you know, it's about the same. You could guess maybe that. This one, international stock, yeah, it's not doing very well. And that's because there's a lot of uncertainty in the international market now. Not only do they have all the COVID-19 stuff to deal with, they got Brexit, all the stuff that's going on with China. So you can see this one's a riskier fund. So you would only look at this fund if you're like, I want an international fund no matter what. And you expect that you might not make money for a while. And here's another index fund. So in general, that's what I do when I'm looking at funds. And I can't say I'm an expert on this, but if I was a newbie and I had no idea what I was doing, I would want to know what other people look at. And these basically tell you what types of funds they are. So this is market index. So, you know, that's the stock market. Money market, these in general will be like your savings accounts, even though they're with Vanguard. Here's some bond funds. These will invest in a variety of bonds. If you click on them, they'll tell you what kinds of bonds, treasury bonds, municipal bonds. You'll just have to see. Balanced funds, these are the ones that they're balanced, so they'll try and be in a lot of different types of funds so they don't go up and down as much. And here's more stock funds, international funds. So as you can see, there's a lot of funds to look at. And sometimes it's just easier to start with one of the combo funds. And as you get comfortable doing that and learn more about the different terms, it's easier to branch out. Okay, so that's Vanguard. We're going to look at Fidelity now. And so they have They have also a very similar website. Nice articles. They have lots of nice articles to explain things. So all mutual funds, we are going to look at these funds. These basically, this is their version of the combination fund, and they named theirs based on risk and based on how much you're in the stock market. So equities, that's the stock market. Bonds, you know what those are now, and short-term money markets. So that's basically a cash buffer. So this one you would look at and see, okay, well, I really don't feel comfortable being all in the market because I don't want to lose all my money, but I want to try something. So you try the middle. You go ahead and say, I'm going to try this fund, the 50%. And so here's what it would look like. This one has a really good rating. Its returns are above average, low expense ratio, and fairly low risk. And here you can see, let's see, I guess you can see, I have to scoot all my pictures over. Here you can see their version of how the fund is done in the past 1, 3, 5, 10 years. And this is a nice chart to look at because sometimes it's easier to see things on a chart than it is just looking at numbers. So here's the S&P. So that's the S&P index. Here's another index that is comparing a 50%. Oh, this is the Fidelity one. Yeah, that's this fund, the orange one. And this one, I guess, is they're comparing just what would you do if I was just 30 to 50% equity. So if you look at this blue line, that's the market line, the one that we've looked at before in lots of our meetings, general trend up. But this is the riskier one. That's why people aren't usually only in the market. So if you want to back off from the market, you would be doing something along these kinds of yields where you're still going up. It's just not as steep a curve. And that's because it's a little bit more secure. For a comparison, we'll look at this one, 85%. This is one that you would want to get in if you had more time for things to even out in the market. This one's not rated as high, and it could be because it's going up and down with the market. Who knows why? I mean, you can find out why if you do more research. Low expenses, still pretty good returns. This one's a higher risk level. And as you can see, it's a little bit lower, but for 10 years, it's around 7%. And they could say in general, the market goes 7 to 10%. That's usually what you can count on, isn't it, Sarah? Like if you're doing your guesstimates about returns.
On the stock market?
Yeah.
Over long periods of time?
Yeah.
I mean, if you, the charts, if you have,
you're going to pull a number out of your hat.
yeah. I mean, if it's like, so I'm sorry, just to clarify, the question is like, what can you expect for annualized returns in the stock market? If you give it decades, you can expect to get close to the 8, 9, 10% number if the future is like the past. Over shorter periods of time, if there's a, here it's kind of 8.9%, over 15 years, it's less than that. But if you give it 25 years, you would expect to get closer to 10%, which is what it's been over the decades in the past.
Yeah. So that's basically, if you're trying to guesstimate something, you can use the 7 to 10% range. Yeah. But it's not guaranteed. It's just a guesstimate. It means you're writing out all the ups and downs. So if you're thinking of that as a guesstimate, this one's 85% in the market, and this one's getting 7.87 over 10 years. So this one actually is not bad if you're willing to take that risk. And it's a risk over a long period of time. So if you are saving for a house that you want to buy in 5 years, you might want to put your money in this. They made 5% over 5 years, but there's no guarantee it'll make that over the next 5 years. So you would want something probably a little bit less risky. Okay, so Fidelity and Vanguard, kind of similar. So now we're going to look at Ellevest. And so this is their magazine. In it, I'm going to post the presentation, and I have links to these pages in the presentation, at least the starting page. And so you can see like their first article, their most recent one is like, how should I invest during a downturn? It's like, what should I do? So they have very relevant articles. And like I said, they're usually like gung-ho, yeah, women investors. Who says we can't do it? Just those men. I put in some hypothetical numbers in here so you guys could see what it looks like without actually having to go through all the steps. Okay, so what you do is you sign up for the account, and they ask some questions about, like, you know, where do you live? How old are you? Are you married? The types of things that might determine, like if you saw an investment advisor, they would ask those things because they're trying to figure out where are you in life, and how much money do you have at your disposal, and how much money do you have in savings. So I stopped here on the, tell me about your savings right now. So these are just made up numbers. I just said, yeah, this is my savings. Here's my checking account. I started a Roth IRA and I have that much in it, and I have this much in a traditional IRA. Submit and choose goals. Okay, so pick a goal to get started with. This is where the big difference, well, one of the big differences is with Ellevest. You pick a goal so you can build wealth, which just basically means you want to save. I'm focused on retirement. I really want to retire. So when I pick my funds, I want them to be under that IRA umbrella. I want to save for a home. And so they actually will use your location to try and figure out, you know, what your real estate market is doing. Well, you want to save for kids? Okay, that's a goal. But instead you want to start your own business. Or I just want to save money just because, like it's at a vacation, a wedding, grad school. I'm gonna pick, I want to save for a home. And I want a home in Texas. And Austin. And I need at least 3 bedrooms. Okay, so first thing it did was estimate. So apparently it has some algorithm that it uses from Zillow, and it estimated that I need at least $86,000 in Austin to buy a home. And it's saying for me to reach that goal, it wants me to start with a one-time deposit of $11,000 and put $900, $927.21 in every month for 6 years. And here's what it would do for my portfolio. It would put me 36% in stocks, 64% in bonds, and 0% alternatives, which not really sure what they consider alternatives. So it's in the stock market, but not completely because it only has a 6-year time frame. So that's probably why they put you heavily in bonds. This one has a standard risk level, let's see, if I said that, no, I, really want to go for it. I like the market, I don't care. See, they changed my balance. They put me in 41% stocks, 59% bonds. And let's see what it did to the time frame. Still 6 years. It didn't change any of those. But here's one thing it did. It changed this range. You guys can see there's a faint graph overlying that line, and that's sort of the what might be graph. Well, you might go all the way up with a very strong market to 102% following this, or a very poor market, you might go all the way down to 73, did I say 72%? $86,000 is the middle line, 102,000 if it's a very good 6 years, or 73,000 if it's lousy. So basically, let's do this again. It basically said, you want to be more aggressive? Well, I can't guarantee things as much. It didn't change it very much, actually. I thought it was tighter before, but so it changed these numbers slightly. So yeah, so basically that's what it's going to say that you have to do. And I haven't actually done it, but I'm assuming if you say continue, you proceed to fund your account by transferring money over from your checking account and getting it set up so that you have some kind of auto deposit, and then you work towards that goal, and they will show you how well you're doing along that goal. So it's a little different way of looking at things, but it might meet your criteria. That you might say, I have my 401k over here, I have my savings, but I really want to focus on this, and I need a separate account for buying a house. Or I want to use this just to start building up my wealth. So as we saw before, you're still dealing with the risk. How risky do you want to be, and how much in the market do you want to be? It just has a different goal, so it'll have longer or shorter time frames, which I like. I like the fact that this one actually focuses on your time frame. It's not like the other ones. It doesn't take that into account at all. It just basically says, yes, put your money in here, and you decide how risky you want it to be. This one, it gives you a little bit better focus by saying, oh, house is actually a short-term goal. We're going to guess 6 years for you. And I noticed they had one. I'm going to see if it'll let me go back. I'm going to build my own business. And so it had different goals then too. And I haven't used this one yet. I haven't really played around with it, but you could probably change some of the values and let it readjust for you. So yeah, so this is saying in 5 years, this is what it's guesstimating for you, that you're going to need 66,000 before you attempt to start your own business. And so it's saying it's going to take you 5 years if this is what you're doing. And on their main webpage, they had, if you go to their main webpage, they had like an article about that talks more about this. So if you're interested in it, read some of their articles, and it talks about their strategy for this and the fact that they used some benchmarks from other places to determine this is 6 years and you're part of the country. Here's how much we're going to just guess for you that you need. So this one's pretty interesting looking.
Hey, Laurie, I have a question for you before we move on. So about Ellevest. So you've tried some of these or you've worked with some of the other companies that you've presented in the past, but never Ellevest directly.
No, I haven't. I just never.
Why?
I've looked at it a lot. Mainly because I couldn't figure out what to pick. I don't know. I also kind of got stumped too with them wanting to know all about my accounts. And I understand why they're doing that. They're trying to make sure my portfolio as a whole is not going to be slanted towards one or the other. But I kind of didn't want to go through that. I didn't want to have all my information at this one company. It's just like a lingering hesitancy about that. So that's the only reason why.
Yeah. So that the way that it's built, which is taking your entire comprehensive financial life into account, was like coming on a little strong.
For me, it was, yeah.
That's very interesting.
Yeah. So yeah, I speculated about like telling it fake numbers anyway, and just if you open an account with them and set a goal, I'm assuming you'll use their what they call robo algorithms, which basically I'll get technical for a minute. It's artificial intelligence looking at the market, using some basic patterns and well-known algorithms to figure out what you should do. And it manages it completely under the covers, like a person is not managing it. They probably have people that tweak the values. But this is another one of those companies. I was about to say everybody gets the same portfolio, but that's not true. They put in some extra smarts where you give this additional information and they put that into their calculations. And it's only as you go higher up on the tiers that you get to talk to a person. But yeah, I really like this company. And I think in the reviews of the performance, I think they're just considered so-so. But since they came on the market, some of the larger companies started opening their own women's investment branch, trying to get that women's market. But I actually consider that just a fop, you know. Oh, they think they have to have a separate name. Well, we can do that. We'll just name it this. Whereas this company, you know, it's run by women. There's a lot of women on the staff. And so they really believe what they're talking about. And they've gone out and gotten lots of research. And they're like doing it right, it seems like to me.
Yeah. Great, thank you.
Okay, so now we're going to look at Asset Builder. This is a remote one. I mainly talk to them via email or on the phone, but they do have an office in Dallas. So if you wanted to drive to them, you could go and meet with them in their office. I was assigned, even just starting off, all I did was just pick a portfolio. And I was assigned a customer representative who would email me. So I wasn't like just totally cut loose, which I liked. I liked the performance I got from it. And I know somebody who basically all of his assets are in this. This is basically where he keeps all of his assets. It could have something to do with the fact that he grew up in Dallas, but he's like all on board with it. So I'm impressed by this one. And so this is one where they decided they would build portfolios that's based on people's risk. And you pick a portfolio. They'll still ask you questions about like your risk tolerance and where you are in your life, that type of thing. And they will even suggest a portfolio to you, but you can go ahead and pick whichever one you want. So here's portfolio 8, which I think they said this one's balanced. So 50% fixed income. So that's like the steady bonds, probably. Emerging markets, those are going to be, they're often international ones. Oh, here's some international. These are like the riskier ones in general. REIT, that'll be real estate. And so that's probably going to be invested in real estate funds, not actually owning houses. US small, that's one of those small cap ones. So 14% in companies that are considered small versus large. So large cap ones are usually considered more stable, but also larger companies they react slower to things, so they might not be as innovative, so they might not grow as much, versus the small ones, small and quick, but they often don't have an established market. So they're a little bit riskier.
And Laurie, I'm just going to interrupt you for 1 second because there was a question earlier on cap, on the word cap, which, just to clarify for everyone, stands for capitalization, which means how large a company is. So small cap, small capitalization, just a clarifying point for the people out there as we're looking at our pie chart there.
Excellent, because you will hear those thrown around all the time, and they just assume that you know what that means. See here, they didn't even put cap. They're just like U.S. small.
Mm-hmm.
You know, you should know what that means. So this is portfolio 8. So down here, they'll show you which funds they would actually invest in. Oops. But you could say, I want to go more aggressive, which actually I did. Because I love aggressive portfolios, which is one thing I inherited it from my dad. My dad was in retirement, and like all of his portfolios were still highly aggressive, even though he was in retirement. And that was basically what he was making his money off of. That's what he was living off of. So sorry, sidebar. So here it's more aggressive, and you can see less fixed income, more emerging markets, more international, more real estate, which could be a little bit flakier, small and large. So this one has a higher minimum. So it's not something you would use to start off with, but and if you like this way of looking at things, sometimes just which company you want to go with might just be based on like, yes, that really resonates with me. I can get behind that. And if you're starting out, that's good, because you want to feel comfortable doing this. You don't want to feel like I have no idea what I'm doing. Because as you do it more, you're going to get more comfortable. You'll start seeing the same terms over and over again, and understanding what they mean. And if you see a term you don't understand it, just look it up on Google. But for starting off, you want to go with comfort and sort of, you know, you're going to do the hard part by just starting, by saying, I am going to just try. And so that's what I would encourage all of you guys to do. So thanks. That's the end of my presentation. You guys were so great to listen to me. With the Zoom, I just kind of drone on, and so I hope I didn't like bore you guys. But if I did, I won't know because you're far away.
Well, there's a bunch of people on the call, so that's a good sign, Laurie. It's not just me and you. There's most everyone else is still on it, so that's a really great sign. Okay, good. You have a couple follow-up questions if you have time, Laurie.
Yeah, what I thought we would do, Sarah, is like maybe do some follow-up questions if anybody wants to write in with advice. In case we don't get to that, put it in the chat note for sure. But I also was hoping, Sarah, that we could talk a little bit about the current environment, because I know that's at the forefront of a lot of people's minds. So maybe we leave ourselves like 10 to 15 minutes at the end of the call to do that. And I would encourage anybody, if you are interested in that and you have a particular question, put it in the chat so Sarah can see it and be pulling those together to talk about. So great. Thanks for pulling those together, Sarah.
Thanks. So I think, so I've been kind of compiling some of the questions and focusing on the ones that didn't get answered in the chat box. Thank you for those of you who are having, you know, question and answer sessions on your own in the side. That's awesome. So I have a couple relevant, I think, to what you presented, Laurie. And then before we get to those, there were a lot of questions in the chat box about accounts specifically. So retirement accounts, like the features and the rules surrounding retirement accounts. And so I think that before the end of the year, Laurie, let's talk about, and Gwen, if you're still on the phone, we can talk about putting a topic on the calendar to deal specifically with how retirement accounts work, right? So that's where the question about, you know, contribution limits and income limits and conversions and all of these things that surround the accounts themselves. Let's put that out and have a separate call on that. So I'm just throwing that out there to those of you who had questions on that. I'm sorry that I don't think we'll have time to it, but they're all good questions. So let's do we'll do a topic on retirement accounts. We've done that in the past, and so we can do that again.
That sounds great.
Have questions on that. So, and feel free to email me directly if it's pressing, right? If it's like something you need to know right this very second on the retirement accounts themselves. So one of the questions on there was a question about fees, Laurie, and so I'll give this to you first, and then you can, I will fill in afterwards. Do you have to pay a fee when you change companies, like when you close an account and move your money somewhere else, or not? Do you have any sense as to that?
I think it's going to depend on the company where you have your money. Recently, I moved some money over from Vanguard to Fidelity, and I didn't pay a fee. It was totally easy. I actually went to Fidelity and said, look, I have these funds over here in Vanguard. And they actually looked to see if they could host them. And they said, no, those aren't ones that we have. We'll kick off the transfer. And they just pulled the funds over to my Fidelity account without any problems at all. And I did that by going down to the Fidelity office in the domain. In case you guys have Fidelity, that office is excellent. They have people there to help you that are totally on the ball, and they answer your question right away, and very friendly, very easy. Some of the companies, if there's like an end load, they will charge you a fee as you exit the fund. And that is something that if you're considering a fund, you should look at. But I would say most of the low cost funds that I've looked at don't have a fee for doing that. But it is something to be aware of.
Yeah, I've noticed on my end when doing transfers that I believe that there's almost never a fee when you move your money from a 401k plan into a rollover IRA. So that is almost always without a transaction fee. But if you're moving from custodian to custodian, almost all of the companies do have an account closing fee except Vanguard.
Oh, okay.
I can't think of another one I think Vanguard is the only one that does not have an account closing fee. So,
and that's my, yeah.
Yeah, as a beginner, I would think about that if you're starting an account somewhere and you could choose to start at Vanguard, and that way, if you decide you want to move from Vanguard to something else for whatever reason, that you won't have that account closing fee. Instead, if you started at Schwab and then move to Vanguard, I mean, you will have, it's something like a $50 or a $75 account closing fee. So it's probably not the thing that you're going to make your decision based on, but it's just something to keep in mind. And thank you for asking the question on those fees. Let's see, get a couple more in here. Can I invest in a Roth IRA if I don't have access to a 401k?
Yes, you can.
Yes. So when you're contributing to any individual retirement account, I know this came up in the chat box. You can find the rules on all of your retirement accounts at the irs.gov website. I know that sounds like someplace you don't want to go, but it's actually really, really helpful when it comes to all the rules around your retirement accounts. So an IRA is attached to your Social Security number. And there are typically income limits. If you make a certain amount of income, you might not be able to put money into the account. But if you don't have access to an employer-sponsored plan, then an IRA is your best option to look at. So, yes, you can contribute to a Roth if you don't have access to a 401k. If you do have access to a 401k and you just don't want to use it, you'll need to meet the income requirements to contribute to a Roth IRA, if that makes sense. Again, we'll carve out this topic and do a whole separate topic on all of these rules later on down the road, because it sounds like people are really interested in that. Let's see. Oh yeah, it says Laura posted some links on for the Roth earlier in the chat box. Laurie, maybe you can clarify on this. Leora was saying that she interprets the emergency fund as an unemployment fund, not the accident emergency kind. Do differentiate between those things? If we can spend a little bit of time talking about the emergency fund.
I've seen people describe it different ways. Some people say that it's basically your bare bones fund, that if you lost your job, it would be like your rent, your utilities, that type of stuff. And maybe they set aside, have an account for the accidents. I don't know. What would you say, Sarah?
I put anything in an emergency fund where I would need cash to pay the bills that came in when an emergency happens. So I don't know if I would differentiate between those two things. I think of an emergency as like the one that impacts people the most, is the most visible, is the losing of the job. So that's certainly it. But I would expect my emergency fund to do double duty. Whatever the emergency is, this is how you cover it. Though I don't know if, yeah, hold on, let me see if, yeah, you want it to be very liquid, which is in there, right, which is really important. Liquid meaning you can get to it right away, that is basically cash. And it's, you know, I think mentioned this in her presentation, like it's really personal to your own situation. Like, what does an emergency look like? Where does money come from in an emergency? When you are investing, the thing you're trying to avoid is selling your stocks in an emergency, or selling your investment properties in an emergency, right? Selling those long-term investments in order to create cash to get through the emergency. So the emergency fund, whatever it's for, is there so that you don't have to sell stocks in the middle of a market crash. So I think you can probably take that and develop your own strategies to what that looks like and how you chop it into different accounts, or how you quantify what the amount is. But the point is that it's the money that's available to cover things, whatever happens, so that you don't have to look at your 401k and say, I need to cash that in, and the market's falling, and I'm going to take a penalty, and I have to pay taxes on it. By the way, though, while we're talking about the emergency fund and emergencies and things in 2020, if you do have to take a distribution from a retirement account in 2020, there are new COVID-related exemptions for taking a withdrawal from a retirement account without paying the 10% penalty if you are under age 59 and a half. So you have to certify that either you had COVID, your spouse, a family member, or that something you experienced financial hardship due to a COVID-related reason, which is kind of broad. And that's why you need to take this emergency withdrawal from your retirement account. Hopefully, there's emergency savings, so you don't have to do that. But if it's, like it's live to fight another day moment for you, just research the CARES Act and some of those new rules that are put in place for 2020. That was an aside. All right, let's see. We're getting about, probably have one more question. Can you, so again, a lot of these were about retirement accounts, so I'm going to punt on those a little bit. But Laurie, can you go back and talk about the difference between the S&P 500 index and index funds, and then maybe even compared to an actively managed mutual fund? What's the difference between those three terms?
Okay, so the S&P 500 is just a group of funds. Sorry, the S&P 500 is a group of stocks that were chosen and identified, and they're basically like a shorthand to see how the market's going. So that's why when you hear market reports, they say, well, the S&P went up 50, and that means those set of stocks went up 50 as a whole. And so they're basically just a way for you to tell, is the market going up or down? And so I know we had a question last time about how often are those changed. I think we decided once a year. So basically that is the set of stocks. If you get an S&P 500 index fund, it is a fund where they have bought shares in those 500 stocks. And so as those stocks go up and down, the fund goes up and down. And usually, since it's just owning those shares, there's not really anything anybody has to do. Nobody has to come in and say, oh, I heard about this other company that looks really good. We should buy that company, because it doesn't matter. It's only the 500 stocks in the S&P 500. And so those will have lower fees or zero fees, usually just lower fees. So that's what they call an index fund, because it is following those set of stocks. So index funds are the broad category of funds that follow some index. Like there's a bunch of different indexes. There's like the Dow Jones, NASDAQ. I'm sure the European markets have their own index funds. The Nikkei, there's an index fund. So when they say index funds, it's just like basically buying the stocks that somebody identified that's on a list somewhere. That usually is emblematic of something. Like you could have the stock market index fund, or you could have, I mean, I've even seen them, they have like bond index funds, and they probably have technology index funds. It's basically somebody somewhere picked a list and published it, and now other people look at that list and compare a particular funds, like my individual funds performance compared to that index fund. So that's partly why they have them too. And they're an easy way to get in the market, is basically the main reason you would be interested in them.
Perfect. And just to clarify for everyone, an index fund is a type of mutual fund. So it's not index funds or mutual funds. An index fund is a type of mutual fund. There are index funds, and then the other category of mutual funds we tend to describe as actively managed mutual funds, which means that someone is choosing a strategy other than this just copying someone else's list. They're trying to pick a strategy that does better than that. So instead of just investing in the 500 companies in the S&P 500, someone develops a fund that says, okay, we are only going to invest in the best dividend payers, or we are only going to invest in the companies we think are the fastest growing, or whose stock will go up the most, or whose stocks will go down the least during a market crash. So once you start like tricking out these strategies a little bit and trying to do better than the general stock market, you start going into the realm of active management, where someone is trying to do better than the S&P 500. So that's something you can take with you, especially as you're choosing mutual funds in your 401k or something like that. What are you choosing? The cheapest generic index funds, or something that's more expensive that's trying to do something better or do something else other than what an index fund does? Really good. All right, we have about 10 minutes yet. Yeah, it sounds like maybe there are also people in the chat box who would like to talk about dividend funds specifically, or dividend investing specifically down the road. We can definitely see if we can carve out something like that.
Yeah, I think that would be a good topic for another time, yeah.
Yeah, this is great. Do you have any closing remarks on investing for beginners, Laurie? Like if you could boil it down to I'm just a beginner, I have not started anything, I have no idea what to do next. Where would you go and what would you do over the next week?
First, I would go and look at my bank accounts and figure out, do I have my emergency fund? Do I have a certain amount of money that if I have to, I can get a hold of, and it's cash, it's readily available? And then I would look at, do I have other money that I could invest? I would take that money and look at different mutual funds and find one to put it in. And I actually would put it in a Roth IRA. I usually like to do that first. And that was one of the first things my dad told me to do. So I'm kind of thinking back to when I was starting out. And so I would probably figure out like what company I liked and then pick a fund. And then if I had to, just make it a basic fund and figure out, okay, I'm going to start with this much. I'm going to do that and I won't hurt too much. And then figure out how much I want to put in every month or every week, and like force myself to go through the effort of getting that set up. Even if it's only like $5 or $10, you know, any little amount, because once you start doing it, you find that you forget about it and you don't miss it at all, but it's growing for you in the background, and when you need it, it'll be really beneficial.
Yeah, and I think that some really good resources for people who are just starting out. There's a website called Morningstar that we talk about quite a bit here. You can get free access to the paid part of Morningstar through the library if you have a library card. But even if you just go to morningstar.com and use their free resources, there is a ton of information there. Again, if you're a beginner, don't get too far stuck in the weeds. It's basically open an account, put money in it, and then invest in some combination of stocks and bonds. Stocks, if you have a long time horizon and you want it to grow. Bonds, if you really don't want to see it go up and down a lot, but you also don't need it to grow a lot. But I think with investing, and I just hear this time and time again and this is how I was when I was starting, you learn more by doing, by just actually going through and doing it. There are very few mistakes that you can make that will like blow up your entire financial life, right? If you open an account at Vanguard and you put $1,000 in and then you invest in something, there's very little that can happen with those choices that you make that are going to completely ruin your life. There probably are no choices that you could make that are totally going to ruin it, right? You might make mistakes. That's okay. And you'll learn a lot about yourself as an investor. That's the most important part. Like, hey, I'm pretty good at this. You know, I'm pretty good at controlling my emotions. I'm pretty good at growing my money. I'm going to keep doing this. Or like, holy cow, market fell really fast in March. You know, maybe I need to readjust my expectations going forward. Like learning that about yourself is the most important thing to becoming a good investor, like learning how it works. And so just like Laurie said at the very beginning, like just start doing it in some way, even if it's just a small stakes way, because you're trying to develop the habits and develop the knowledge for doing it.
Yeah, and I would even say, don't worry about making a mistake, because you're going to let yourself revisit it later. Mm-hmm. At a minimum, say that every year you look at it when you're doing your taxes, mm-hmm. because you have to get all of those forms together anyway, and they give you the year-end results. And usually they tell you, here's what you started at, and here's how much you put in, and so here's how much you made. And that could be the time that you say, okay, this one I'm going to revisit it. Otherwise, I'm just not going to think about it. Because that's the other thing that when you're starting out, it seems kind of worrisome that it's going to take a lot of time. Mm-hmm. It's like, I don't have time to do this. But it's just how much time you choose. You could choose just to do it once a year, and then the rest of the time you just forget it. Or you could choose to do it once a month. You know, so whatever feels comfortable to you and lets you take the step forward, I think is good.
Yeah. And just a little bit on market related, kind of current market related information for people who are either looking to start right now, like what are the expectations that you should have going forward? In 2020 and for the rest of time, your expectation should be that the stock market is going to go up and down and sideways in some pattern that is unknowable to any of us on this call or in this room or probably in this world. That if you are going into the stock market for that long-term growth that Laurie was talking about, that takes time. The stock market is driven by companies' ability to generate profits. So right now in 2020, every company in the world, without exception, is looking at how it makes money and trying to figure out how it makes money in this new world that we are figuring out as we go. Some companies will be able to make as much money as they did in the past. Some will make more money than they did in the past, and some are going to fail. They're not going to make it. They're not going to be able to make it. And that's a natural cycle in the stock market. So while what precipitated this crisis is new, the way that it's reverberating through the stock market is not really new. It's a variation on a theme that you can expect for the rest of time, which is there are times when companies grow and expand and make a lot of profits. There are times during the business cycle where companies fail and don't make profits, and the stock market will go up and down in the short term. But the reason we do it is because we expect, by hanging on through the ups and downs, that we'll make more money in the long term. So there's no, like right now, unless you have some sort of super special knowledge, which maybe you do, about where the market's going to go in the short term based on the news that's coming into the marketplace. I mean, it's tough to say that now is not a good time to get in the market if you have a 20-year time horizon. If you're looking to make money over 1 year, maybe the market's up, maybe the market's down over 1 year. 2 years, maybe the market's up, maybe it's down. 5 years, then people start being able to look at what's happening now and thinking like, okay, something will have happened in 1 or 2 or 3 or 4 years, and hopefully 5 years, the general environment is better. Certainly 10 years, we would hope that we've worked something out with whatever's happening now. And then 20 years, I mean, you really hope that 20 years from now, we are in a totally different place than we are now. That's why you're in the stock market. If you think about that, the ups and downs in the short term, and you're like, nope, I just can't do it, and I won't do it. Great. Like, know that about yourself, and then you can start thinking about other asset classes to invest in, you know, whether it's the bond market or the real estate market, something else. It's okay if the stock market is not for you. But if you can think about the new technologies and the new companies and the new businesses that are going to be grown out of this crisis, if you can see that in the future, then maybe you can have some money in the stock market. And you will always have to get through the short term to get to the long term. It's never a straight line up. Sometimes it's almost a straight line down, like it was in March. So heads up, because that's rough when it's happening, right? But we stay in it with the expectation that the companies we're investing in the stock market will figure it out over time. And I know that's not like a great answer, right? But there are no great answers in the stock market, unfortunately. The reason you get the higher expected rate of return, like Laurie was showing you, was because you're taking the additional risk of the uncertainty and all of that volatility that happens in the stock market. So that's part of learning to be an investor, is how much are you going to opt into that? And if you're not going to opt in, figure out something else to invest in. We will cover topics on real estate investing. I always say we're going to do something on bonds. I think maybe we'll do a bond market, bond investing topic coming up. But just that, part of it is figuring out where your own risk tolerance is. And feel free to email me about any of this.